Imagine making a handshake deal with your neighbor. You lend them enough money to buy a bicycle today, but there is a catch. When payback time arrives a few years later, they don't owe you the cost of a bike, they owe you the cost of a car. Let's translate that exact deal into gold. You lend someone 2,684 rupees today. In 8 years, they return whatever 1 gram of gold is worth on that exact future date, plus a little interest every year. In 2015, the government of India offered this precise deal to millions of its citizens. It was called the Sovereign Gold Bond Scheme. The government had a very practical reason for doing this. Citizens were importing massive amounts of physical gold from overseas, which was draining the nation's funds. By offering citizens a paper gold bond instead, the government hoped to keep that money inside the country. At the time, it looked like a perfect solution. Savers got a secure investment linked to gold, and the government protected its foreign currency reserves while borrowing money cheaply. Recently, financial researchers started looking closely at the government's books to see how this decade-old deal has aged. They asked a simple question: what happens to the borrower when payback time arrives and the price of the thing you promised to return has changed significantly? Linking a national debt directly to a volatile commodity without setting up a way to offset price changes created a structural mismatch between the money the government raised and the money it would eventually need to pay back. This bar chart shows the exact scale of the initial borrowing. Between 2015 and 2024, the government successfully raised 72,274 crore rupees from citizens through these bonds. But as we overlay this line graph of global gold prices, you can see the shift. Gold shot up from roughly 2,600 rupees per gram in 2015 to around 14,400 rupees per gram today. Because of that surge in price, the government's estimated debt to those citizens has exploded to 1.87 lakh crore. That is more than 2.5 times the original amount borrowed. The government knew gold prices could fluctuate, so they created a dedicated savings jar called the Gold Reserve Fund. This was meant to hold money set aside specifically to pay off these future gold bonds. This diagram shows the state of that savings jar today. Next to the massive 1.87 lakh crore debt block, the reserve jar is a microscopic sliver, holding just 697 crore. It covers less than 0.5% of what is owed. The safety net has effectively vanished, right as the largest wave of bond payouts is preparing to come due. How does a debt this large stay out of the headlines? Think about buying a house 20 years ago for 10 lakh rupees. Today, it might be worth 10 times that amount, but on your original paperwork, it still says 10 lakh rupees. In government finance, there is a practice called historical cost accounting. It means recording a debt based strictly on the original money received, rather than what it would cost to pay it off in today's market. The government relies on historical cost accounting for sovereign gold bonds, so when parliamentarians review the budget, they only see the original 72,274 crore rupees that was borrowed. The additional 1.15 lakh rupees that is now owed to citizens is not visible in official budget documents. While this accounting method follows standard procedures, it creates a blind spot for lawmakers trying to gauge the true fiscal health of the nation. The story gets more complicated when we look at the nation's central bank, the RBI. The RBI holds massive amounts of real, physical gold inside its reserves. When global gold prices rise, the central bank makes a paper profit on that physical gold. It then transfers cash dividends back to the government, which makes the national deficit look incredibly healthy in the short term. However, the same rise in gold that makes the government's daily accounts look better is simultaneously driving up the total massive amount it must pay back on those bonds in the future. Those prices are staying high because foreign central banks are buying record amounts of physical gold to diversify their own savings. This international buying spree has kept gold trading in a higher price range than the scheme's designers originally expected. This means the Indian government is now managing debt at prices dictated by geopolitical forces far beyond its control. To be fair to the government, sovereign gold bonds successfully achieved their original goal. They diverted demand for physical gold and helped stabilize the nation's currency reserves in 2015. However, by failing to set up a financial buffer against price spikes, the state has allowed a large hidden burden to grow on the national balance sheet. This leaves us with a few essential questions. First, should national accounting rules be updated so that the public and parliament can see the true current cost of all government debts? Second, look at the logistics. This timeline shows a massive wave of bond redemptions scheduled to hit between 2027 and 2032. How will the state fund these payouts with an empty reserve jar? Finally, is there an inherent conflict of interest when the exact same entity that owes a gold-linked debt also controls the import taxes that influence domestic gold prices? Whether you are balancing a family checkbook or managing a national economy, the facts remain the same. True financial health requires measuring your promises by what they cost today, not what they cost yesterday.